discuss earnings. IndusInd Bank on board. Romesh Sobti, who's the MD and CEO of IndusInd Bank, joins us to discuss their numbers and more. Mr. Sobti, it's great to have you on the show. Thanks very much for taking out the time. Good set of numbers. Take us through the highlights. I mean, there has been a contingent provisioning of 275 crores that has dampened profits. Would you need to make more such contingent provisions over the coming quarters?
Well, I think there was no sort of compulsion to make this provision, because the accounts are standard, and going forward also, at least in the immediate future, we expect them to remain standard. But there is a change in the management. There are structural changes that are happening in this group, and also there's a resolution plan in place. Therefore, based on these developments and based on our best judgment at this point of time, we felt that a contingent sort of provision of this nature, which is 275 crores, would be prudential. And this has been done in agreement with and in collaboration with our auditors, who also have a sensing on this score. So we hope at this point of time, we feel that this is a justified sort of a provision. We call it contingent because there is uncertainty on whether it will happen or not happen, whether we'll have to provide or not provide. But let's keep this aside, because we find that the underlying growth is pretty strong, and it's just one quarter one-off effect.
Okay. Then just to clarify, do you have exposure only to IL&FS securities other than ISSL? Do you have exposure to any other entity within the IL&FS group? Because I think that's what the market wants to seek from you.
No, so this is not relating to ISSL. That is a securities company, which is a separate acquisition sort of effort that we are doing, and which we hope will go through sooner than later. But this prudential contingency that we have created is for the IL&FS group.
So would you share with us that what is your current exposure to the IL&FS group?
No, I think there are privacy issues around that, but we've disclosed a provision which should speak a lot about our exposure.
But we must say that, or can we say that besides the contingent provisioning, it's been a good quarter. So what has led to profit growth and advances?
Yeah, I think the loan book growth has been pretty, as you call it, secular, and is driven by both the retail and the corporate side. The corporate book grew by 35%, and this is after we have done some sell downs as well. So the growth was very strong, and is spread across sectors, so it's not one or two sectors that we have done that. And on the retail side, we have very strong impetus on the vehicle finance side. Our disbursements on vehicle finance jumped by 40% during the quarter, and in which CV was 44%, and the loan book grew by almost 30%. So pretty strong growth there. Then the non-vehicle retail also has picked up. Our business banking group has done well in this quarter. And the other products as well, they are smaller in size, but they're all growing in the range of 25 to 35%. So that drives the loan book growth, and therefore the interest income growth of 21% that we showed.
Right. So while gross net NPAs, Mr. Sobti, are stable, what about the second quarter slippages? And also if you could share some color on the asset quality trends in vehicle finance, your retail book as well as your MFI book.
Yes, so if you look at the quality of the loan book, both gross and net NPAs have fallen. Our credit cost has fallen to a new low of 12 basis points, and for the half year 24 basis points, which means annualized it is well within our budget or target of keeping it below 60 basis points. Not only that, I think if you look at our ARC book is 3 basis points for book, and if you look at our restructured book and gross NPAs is down to 1.2%. So I think it's pretty secular and well spread out. The other element that you ask is the vehicle finance book is I think going apace. There are very small and minute increases if you look at product wise. So commercial vehicles gross NPA has actually fallen. and for a three-wheeler it might have risen 1 or 2 basis points, but not material to this whole thing. Our days overdue is what we measure in the vehicle finance. The days overdue are actually going down, because a large part of the portfolio is commercial vehicles, where we are seeing more money in the hands of the transport operator, because freight rates are holding up in spite of the increase in fuel prices.
Right. So while vehicle finance growth has been strong, do you think it can sustain given the issues in the bond market as well as your NBFC book?
Yeah, I think that if you look at the operating environment of commercial vehicles, generally I think we are seeing a very strong momentum, and our own internal view is that this momentum will continue for at least a couple of years. It's not a short-term sort of increase in the momentum. So it looks pretty secular, and we hope to stay the course here. The NBFC part that you mentioned, I think there was some pricing play that was coming in, and I hope that as a consequence of the revision in the approach that the NBFC will now have to loan growth, I hope that pricing will have a much more rational sort of way going forward.
Right. What are Q2 margins and outlook on margins looking like? How do you see cost of funds and yields rising?
So, you know, the margin play, I think for the industry as a whole, and to some extent ourselves as well, is that the cost of funds led by cost of deposits has risen faster than the yield on assets led by yield on advances. So I think there is a lead lag that is still playing through. It's catching up. I would expect that maybe for another quarter or so, or maybe two, you will see this lead lag where cost of funds is rising faster than yield on assets, and therefore some squeeze on margins is there. It's visible in our book also, but it's well within 7-8 basis points, etc. And I would imagine that this would go through for the industry as a whole. So that catch-up game is really the play out of the MCLR regime, that you can't change the MCLR if you have a 1-year MCLR fixed for a loan. You have to wait it out only when rollovers happen. But we are seeing a very good repricing of the book. Our corporate book repriced by almost 53 basis points during the quarter. The retail book repriced by about 17 basis points, but the repricing is not enough to take care of the cost of funds. So I would imagine that a little margin squeeze ought to be visible in the next quarter or so.
Now, as an industry player, do you think IL&FS situation can lead to further stress in the markets, and do you think we may see resolution on IL&FS given that we have a new management now?
No, certainly I think there is a vote of confidence in the new board and the new management, and a resolution plan from what we hear is underway, and that should come out sooner than later. There's a target of doing it by end of October, and I think that will bring about a sort of play out of the way forward on the monetization of assets, infusion of more funds and things like that. Now that's one part. The other part which we saw, that the NBFC scare is not got too much to do with this particular group that you mentioned. I think that scare was created by also another event where there was a small bond sell-off at a out of market rate, and that's caused a little scare. But net what you derive out of this NBFC sort of scare that came there was really that how are they funding their books. And I think that's why you've seen the regulator also say that there could be a tightening of the asset liability management regime that the NBFCs follow, and therefore you could see that some impact on their margins will certainly happen as a consequence of that.